session was about bringing together resources that could be really powerful for your team. And so I will bring up the panel, and if I could ask the folks from the panel to join me on stage while I'm talking about this. We have a great group of people who will be able to provide a set of perspectives from varying points in the real estate investing career, as well as their individual expertise. And I think second, we want to get to know you. So we took the approach of framing some of the questions here as FYIs or discussion points for people who are at the early stage in their investing career, people who are looking to decide to ramp up, and people who've been established for a while. So I say that to say we'd like you to ask questions as the panel gets going. Obviously this is meant to be informal and informational. So I have questions for the team, and I'll ask them, but definitely take the time to think about questions that you might have, because we have people who can speak to the entire life cycle of your investment career. So with that being said, I'm going to actually let you all introduce yourselves, because I think it's best when the crowd hears from you, maybe starting with Krystle. Could you just give us a minute about who you are and why you're here?
Yeah. Hi, everyone. My name is Krystle Moore. I'm the broker and owner of Pacific Shore Capital. We specialize in multifamily and commercial financing. So I've been doing this since I was 19 years old, so that's about 16 years now. Also in 2013, I started a property management company, Pacific Shore Management, and at its height, we managed 965 units. We also had in-house maintenance. We did renovations, so I've turned over 1,800 units in our portfolio, and I've also helped clients and as well as ourselves to renovate 28 buildings here in San Diego. So in late 2017, I sold a good portion of that portfolio to Mind Management, and that's how we're affiliated. So we are also real estate investors. So I drink my own Kool-Aid. We heavily invest as aggressively as we can, and having the experience in owning our own real estate, running a property management company, maintenance, renovations, it helps me with my clients, not just with financing, but how to structure their overall deal. So my goal is really to help as many people as I can to increase their wealth and get consistent cash flow through leveraging real estate and maximizing their property's full potential.
Awesome. Terry?
We're lucky she married in. I'm Terry Moore. We have no relation. My life has prepared me to be of service to you. For more than 40 years, I've helped adults make wise choices about money. And as I look out, I see 150, and through the Ethernet there's more, heroes and heroines who are the heroes of their own story. And our team is different from several worthy competitors. There's 12 great brokers that you could have had speculate on the market. Part of what makes our team different is we're focused on your success. I started out, this was a job, it became a career, and then later it became a calling. I have silver hair. He's got a little bit of salt in his hair down there, but I'm pretty much all silver hair these days. And for me, this is part of my legacy. The idea of whatever I've learned is only valuable to the extent that it helps other people. That makes sense to me. And our team focuses as a team, and we aim to be the people who complain least, and cooperate first. Our job is to help you win. And part of that is part of what Doug was talking about. You got to figure out who the decision maker is, what matters to the decision maker, help them figure out what they're willing to pay to accomplish their goal, and then set about helping them do that. Once upon a time, I was a commercial loan officer with the world's largest bank. And the right cash flow for little old lady was much different for a young man. We talked about building and harvesting. I've written a book about building legacy wealth. And the guy who's building his wealth is in a different stage from the couple that's harvesting their wealth. So we need to know what our clients want. We need to be client-centered brokers And part of what we've done over the last 25 years is tried to pay attention to what was important for you and then help you figure out what was the right way to get to where you wanted to get. We don't have to agree with you, but we need to understand. And had a small business, I was a banker, been a broker, been a developer, been a syndicator, but all the way through it was trying to figure out what are the characteristics of the cash flow, what are the risk and reward, and who is the right fit. Because one of my clients is a, let's say, 30-year-old fireman, and the right cash flow and the right property for him is exactly the opposite of his 78-year-old uncle. So we need to figure out what's important for you and how to help you get the right mix. And to the extent that we do that well, then we're fulfilling our calling of helping people make the most important financial choice of their next decade.
Awesome. Thank you. Bruce.
Hi, I'm Bruce May. I like puppies and walks on the beach.
How do you feel about world peace?
He's done this before.
I'm a lender. I work with or for Trillion Capital. We're hard money, and I like to say a fix and flip recovering addict. I used to do that, and now I just focus on hard money lending. Our products are primarily all investor focused, and we cover Southern California. We do residential fix and flips, apartment fix and flips, construction, bridge loans, and we have a rental product for those that are looking to hold properties in your portfolio. And we're all about quick and easy lending. We do stuff rather quickly, and when I say quickly, I'm talking about weeks instead of months, as many of the lenders will do, many banks will do. So the fastest we've done anything was a 14-unit apartment building in less than 24 hours in December. So we're very nimble and able to perform.
Rosie Cooper. I have 19 years of real estate and construction experience. I bought my first duplex when I was 22 after reading Rich Dad, Poor Dad because it just made sense to me. And I am lucky enough to call real estate my full-time profession. I run JPI West here in Southern California. We do $300 to $400 million annually in development production. Right now we have about 900 units in operation and another 1,700 units under construction. So I run our Western region in that Southern California and Phoenix.
Thank you. Hi everybody, I'm Aaron Taylor. I have the dubious distinction of being Doug Bryan's high school teammate. I also won a Super Bowl with the Green Bay Packers, and we beat the 49ers in the NFC Championship game, so thanks, Doug, wherever you are. I'm the novice up here, the newbie. The only thing I'm an expert in is my own experience, but that experience has value through the context and lens of not really knowing what the heck I'm doing. So I'm smart enough to know now that I don't know a whole lot, but I've been really good at surrounding myself with teams and people that know more than I do. I either hire them or I attract them by hook or by crook, and that's just been a real good part of my success equation, is just leading a good life, being a good dude, and I've failed my way to the top. I assuredly have the lowest SAT score of anybody up here. My degree was in sociology from Notre Dame, and I subscribed to a 3x5 would keep me alive, and it got me through college. But I think what I've been able to do through real estate over the years is make good decisions, and the very simple things and the basics and the fundamentals of location, location, location. I moved here to San Diego in '98. I did some fix and flip stuff in the run up to 2008 and 1031 with a good buddy of mine. I've done some hard lending over the years. Real estate's a vehicle that's smart enough for what brain matter I have left to kind of wrap my head around. So I'm intrigued by it. It's something that I can understand, and we'll get into some of the fundamentals, but sports translates directly. And we heard Brian talk earlier about the metaphor of the quarterback. I need to stay in my lane and do what I'm really good at and make sure that I'm associated and have people on my team that are really good at the things that they do so I can focus on what it is I want to do and can do. So that's kind of my spiel about who I am, where I come from, how I ended up here, and I've got direct experience with working with this company. I'm happy to share that as we move along.
Awesome. One of the things that I take away from this panel is we just have a range of people with expertise and different stages of development, and I think that's really going to be valuable. I'd actually like to start maybe with the financiers on the panel and talk a little bit about, what are you seeing in the market today, right? Are you seeing a flight towards SFR, multi? What kind of strategies are you seeing from your client base that you think are worth sharing with the team?
I can go first. Because I specialize in multifamily and commercial lending and predominantly multifamily, and I also really believe in myself. I think everything kind of comes down to what your preference is, but I prefer multifamily mainly because investing in single family homes is really tough to cash flow. If your tenant moves out, you've got 100% vacancy. You're paying that mortgage, you're covering your turnover costs, you're covering your vacancy loss. So I really do believe in investing in multifamily, and I think people always need a place to live. So I really believe that it's the safest investment that you could possibly put your money in. So that's kind of what I'm seeing, and those are the people that we work with.
For us, we're seeing a shift in the market from that median home to the higher end houses. More of our investors are focusing on coastal properties that are above $750,000 up to $1.5 million. And then we've also had a significant shift from our single family buyers that are now looking at apartment buildings from 5 units all the way up to 20 units, kind of in that size range. And they're doing that for buy and hold as well as flipping apartment buildings. So there's been that change over probably the last year or so.
Gotcha. Now, Rosie and Aaron, I'd be curious as kind of principals, right? Are you seeing the same kind of things, or does your investment strategy not align with what they're seeing in the market?
Talking to me?
Yeah, let's
Okay.
go with you.
I'm
passing the ball.
Man, hello. Who are all these people? How'd I get here? That probably sums up my investment experience and my ability to be able to see and observe things that are going on in the market. I've seen an appreciation in prices. I think my wife and I are aggressively trying to figure out what it is we can do as our next move, our next deal, building number 2, if you will. Full disclosure is Pacific Shore Capital Management was the management company that I first was introduced to the multifamily game with, and they were acquired by mine. So it was pure coincidence that mine is owned by a former high school teammate of mine. But Krystle, I think, was really integral in educating me about the principles that she, I just think, very thoughtfully laid out. I've got some single-family residence investment properties here in San Diego. I've had some in other places in the country, and the multifamily game is a different game. I had an opportunity to sit on a flight next to this guy named Carlos Royal, and he ended up being a big Oklahoma football fan. I had just come from the University of Oklahoma giving out a college football award, and we started talking this owl box that he created and was a YouTube sensation, and then got into multifamily. And we've developed a little bit of a relationship, and he said something to me that was pretty profound that I think is held true and kind of really put context around what this next phase of my wife and I's investment strategy is. And he said, Aaron, when you're in the game, the rules work for you. When you're outside the game, the rules work against you. You're now in the game. Your job is to make sure that you stay there, and you'll never have anything to worry about. So for me, the single family residence model that I've had has done well, but there's an exponential factor that has shown up for multifamily for the first time in my life that I never knew existed. And I'm looking around like, is this too good to be true? Now, full disclosure is also, I couldn't have bought any better than I did. I 100% financed it with a gift from the skies and the heavens that dropped in my lap as an $800,000 loan at 2% simple interest for the down payment from a buddy/neighbor. So I had a lot of things go right for me, but again, it goes back to my investment philosophy, which is just be a good dude, help people out when you can, and good things tend to come back to you. And us being in the game is a perfect example of that.
Now, Rosie, you're a developer, right? And so I would imagine you take some longer term risk in that. Like, how do you think about the landscape in the Southern California market relative to single family versus multi?
Yeah, sure. So we're strictly a multifamily developer, but I think some other panelists have touched on this. We just need more supply in California, and our housing affordability problem is not going to go away if it doesn't get easier for me to develop. Rents are going to continue to go up. We're going to continue to have affordability problems on the rent side if we can't solve the supply side, whether that's more single-family housing that the bureaucracies decide to allow to happen, or multifamily, or whatever it is. We just need more rooftops in California.
Yeah, I hear that. I mean, I think that's really important because for myself as a novice investor, I worry, is this going to go up? How am I going to get my money back, et cetera, right? And I think the stat that Doug said and that you just touched on of a massive imbalance in need for housing versus the amount being built that helps me sleep at night, because then at least somebody will buy this home or building at some point, right? So that leads me to Terry. So I'd be curious, just given what you said earlier about the way that you approach advising someone who is just starting out in their investment career versus someone who's bought a bunch of buildings over time, right? Like, how do you think about the difference between those two for people in the audience who may be on one side of the spectrum versus the other?
Well, there's a long answer and a short answer. I just happened to have finished a book, thank you, John. Took 2.5 years to write down some of the best things that we learned with and from some of our clients. And when we wrote the book, the idea was we wanted to help people no matter what stage they were. Ken Blanchard has a learning model that I found honoring. It starts out with, I'm a novice. I don't know nothing. Would you teach me? And then you become an apprentice. Did I do this right? What do I need to fix? And then later, you get into the journeyman. Get out of my way, I got this one. And then finally, there's the master craftsman. He does it in his sleep, he can't explain why, he just knows. Well, with some of the folks here in the room and some other folks, we've helped people at every stage, and we help them try to get better, try to get them the next stage along. The supply and demand is immense, and San Diego and a few other cities are uniquely gifted. There's some places in the world, in Oklahoma, figuratively speaking, you stick a straw in the ground and oil comes out. In some places, you flip over a shovel and you find diamond, or you find silver, or you find gold. You didn't create that, you were just there. Well, in Southern California, we didn't invent it, but because there's a supply and demand situation, drunken fools make money here. Whether you've got condos, whether you've got houses, whether you've got fourplexes, whatever, but we have a screaming demand. SANDAG, San Diego Association of Area Government, says we're more than 100,000 units behind, and we've got this big building push. There's no government in San Diego County that thinks that we're going to create enough housing in the next decade. Whether we're going to fall short 10,000 units or 4,000 units or 2,000 units, we're going to fall short. In Houston, they build enough for those citizens who didn't graduate from college. Houston has roughly 1/4 the population of the state of California. And Houston, in the last decade, built more apartments and condos than the state of California. Rent's cheap in Houston. Apartments are cheap in Houston. They build for their citizens. We build for our Stanford graduates. Until the wives start lobbying the local planning group to say, let's build more housing, we're going to fall short. Now, the good news is we're in the upper half, maybe we're in the upper 10%, but we're entrepreneurs. Whoever's going to wash the dishes tonight, whoever's going to vacuum the floors, they've got a problem. In Kansas City, in Des Moines, in Birmingham, in Nashville, they don't have problems. They build enough housing. But we don't build enough housing. Until we correct that, it's going to be great for landlords for a while. So whether somebody's got 4 duplexes or an 8-plex or 20 units, right now, things are really good for landlords. I might be the oldest guy in the panel. I may be gone before rent control happens in the state. She won't be. For a while, it's really good for rental owners, but we're going to need to address this. The income inequality is not going to go away. It will get solved. It might get solved intelligently, or it might get solved poorly, but it is an issue that we're going to deal with for our entire investment career. I talked with a father and son today, and roughly speaking, I said, start 5 years ago and keep doing. You know, He also had a situation where he's probably quadrupled his net worth. And his next step, he could buy a triplex or a fourplex or fiveplex. But as long as he's in the game, he's going to do incredibly well, almost regardless of what he does next.
I'd like to run with that point for a second, come back to you, Aaron, actually. So one thing that we think a lot about at Mind and with our clients is, what is the trajectory for scaling up, right? And I'm going to come back to a few people on the panel on this, but one thing I'd like to better understand is what were some of the hurdles you had to jump in getting to a larger portfolio size, and what kind of resources did you wish you had or knew about before getting to that place?
Well, I think capital, right? That's always the big easy one. There's an African proverb that says the best time to plant a tree was 20 years ago. The second best time is today. So I wish I had started and knew all this stuff a long time ago, because I'd be farther along in the cycle. And I'm in my mid-40s and my children are 10 and 9. They're going to learn this quite a bit earlier than I have. And that's, I think, generationally, when I look big picture, that's important to me. The financing was a big part. I think I was going to rob Peter to pay Paul to get my first building, and I had some gold, and I had some stock, and I had some cash laying around, and I was going to piece together the 30% down payment to buy building number 1. So I've got a neighbor of mine, a real good buddy that I've had coffee with over the years for 10 plus years, and he's an ex-Navy grad, never graduated college, and he and his wife opened up a furniture business in Tulsa many, many years ago, and he said, I didn't know anything about furniture, but I knew spreadsheets, and I saw that I was, spending too much money to the dude that owned this building, so he bought the building, and that was like the first of 50 acquisitions that he's made that he owns outright still. It's just the classic millionaire next door scenario. So he was kind of my last eyes before I went and took this situation, which looked like a good deal, was recommended by a very good buddy of mine who's in this room, and it kind of passed his sniff test. So I trusted him, and trust is a theme that I'll touch on before we're done here. But he was the last set of eyeballs, as the young novice or the apprentice is like, man, tell me, I know I don't know what I don't know, tell me what I don't know. Am I okay doing this? And he looked at it and literally got a napkin out, started running numbers. He's like, yeah, you could do this, but I've got money sitting in a USAA account. How about I give you that at 2% simple interest? Just a little premium on what I'm getting now. I'd love to help you get your start. And boom, that's how we financed 100% of our first deal. It was like, you can't make this stuff up. It just literally fell out of the sky. So the financing piece now, my wife and I are trying to figure out, we've got this balloon payment that's coming up in 3.5 years. How do we get my neighbor out whole? Hopefully, fingers crossed, that money will still be available for deal number 2, but I can't count on that. How do we figure that out? So now I'm looking at single family residences, looking at historically low interest rates still, values that are high but are typically, the chance of these vectors crossing are greater than not. Do we take the money and run and have that be some capital infusion to couple that with what we currently have, cash out refi and go get building number 2? So we're looking at all our different available options, including tightening our belt straps and saving money so that we can add to that pot as we go along, just to ensure that we can maximize whatever that deal number 2 is going to look like. So it seems like the real estate market is tailed off and is kind of at this crossroads, and whether it does that or that or that, nobody knows, but we're getting ready. And I think personally within our household, in 2008 and in 1999 when the dot-com crashed, I was calling my broker at 11 o'clock at night. I was looking at my values on paper and the sky was falling. Now I'm like, what? Stuff's about to go on sale. So I'm trying to get ready to take advantage of these depressed prices that I think I and all the smart people that I've talked to have told me that that's what it looked like. And I'm looking at some of the data points that we're just getting ready to amass as much dry powder or dry milk as we can, so that when we need to add some water to it, we're going to be able to do what we want to do.
Awesome. I took a couple of notes. One was take everybody out for coffee, because you never know who has money sitting around. Lesson number 1. So if anybody wants to get coffee later, let me know. I'm buying.
If you want to move next to me, let me know.
That's exactly right. And I think number 2 is the point about capital. That's actually really important. And I want to touch on that with you, Krystle. So I know your story personally, and you and Kenny are doing a lot of great work. But also as a financier, right? How do you approach positioning yourself to be able to finance the deals and also find deals that are worth financing?
So as a lender, our business has been primarily referral, so we've been really fortunate since I've been doing this since I was, so young, that I've built, this is a very small industry, and so most of us know each other. But finding deals for ourselves personally, it goes back again to what so many people have talked about already, is having a really good team of people. So partnering with the right broker to help you find deals. And we did get, I wish I had a neighbor that would have lent us money to buy a building, but we didn't. So the way that I got into real estate, and I think is probably the easiest way when you're kind of short on cash and you're not sure how you're going to take that first step, but you want to. My now husband and I purchased a home in 2012. So we bought it with FHA financing, 3.5% down, reserved as much cash as we could to do a renovation on that home. And then we also added square footage. So we lived in that home for 2 years and then took advantage of the tax laws and took $500,000 tax-free and utilized that to buy our first building, even though the home was beautiful and I was almost crying leaving the door. I promised my husband no vacations, no nothing, just let me stay here. But we did do that, and that kind of enabled us to buy our first building. So at first we did it with partners. It's never been my goal to have partners. My goal in life is to do what I want, when I want, how I want, and not to have to answer to anybody. So at first we did have partners because I really do believe in owning multifamily. And the bigger the building I can afford, the more of my tenants are paying my mortgage, paying my operating costs, and I'm not going to have to put in a capital contribution. So we've continued to grow our portfolio through basically buying value-add properties, renovating them inside and out, maximizing the rents, refinancing, taking that cash out, and even after a couple of years, we're selling our buildings to trade up. So as an example, we're currently selling 2 of our buildings right now that total 16 units, and we're in contract to buy a 30-unit building. So that, for me, our goal is 100 units within 2 years, and that to me is the fastest trajectory to get there if your goal is to grow.
Awesome. Now, I'd like to take a slightly different position on that discussion with maybe Bruce and Rosie. So when I think of fix and flips or I think about developments, right, to me, there are different types of risks there, right? With fix and flips, is somebody going to take this and buy this from me kind of risk. And then with a development, there's arguably like a timeline risk, right? The market could shift and your pro formas could be different when you're finished. So I'd like to talk to each of you and just hear a little bit about how you manage and mitigate those risks, right? Because being an investor requires taking a risk, and you two, I would imagine, are arguably in the position to see or interact with people that are the most comfortable with it. So how do you see them mitigating those risks? Maybe starting with Bruce. Starting with Rosie.
So part of the way we mitigate risks is when we're executing on our pro forma and drafting our pro forma, we're looking at all different data sources, which is what I know you all were speaking to earlier. So we're looking at CBRE, we're looking at CoStar, we're looking at Axiometrics, we're looking at Witten to see what rent growth projections look like, and we're averaging those, and we feel like that gives us a lot of cushion. And at the back end, we're putting a cushion on our cap rate to say, we probably put about 10 basis points of cushion per year on our cap rate, and we think that's pretty conservative when we're actually executing on our pro forma. So on our side, that's how we look at it. And then also, we're trying to diversify and not build everything in a core market. Maybe we're going to a secondary market that we think the rent growth might look a little bit better given where we are in the cycle, which really brings me back to we're always looking at data, like you guys said, and trying to put our hands on the best data possible in order to mitigate our risks in the long term.
How about you, Bruce?
For us, we have such a wide range of investors that come to us, from the novice to the most experienced, and it's a different conversation with each one. There's probably very little conversation that happens with that experienced investor to mitigate risk, but on the beginner versus intermediate, having flipped homes myself and done so many, I think that the insight that I can have that conversation with them is to get them to realize some perspectives or some things that are outside of their control, such as market timing, being able to sell as quickly as they think. We are seeing more investors now that thought that they would get something in contract within probably a week to 2 weeks, and now it's taken a couple months for them to get the same house under contract and sold. So having the knowledge and gone through a couple of cycles myself, I think that helps talk to them about those intangible items, because there's other things. I mean, obviously, they expect a certain return for the price point. You know, their after repaired value on a project, and they know what they're getting it for, and they probably know how much it's going to cost them to fix it, but they don't have control over obtaining permits for a room addition, which, you know, they think they'll get it in a week or two, and the city of San Diego, for example, is taking 2 to 3 months. So you got to build those things in. Some of those are known factors, but you want to just try to look at as many things as possible, and being involved in different networking groups, whether it's a real estate club or you know, a mastermind group, or coming to an event like this and talking to people that are in the business. You probably pick up one little tidbit of something you know, during your conversation with someone here that'll help you out and make your day well worthwhile. Oftentimes it's not about the information that's coming from the stage, but it's the conversation you have in the hallway with somebody else later, and you take that little golden nugget away, and it helps you out.
Now, I think you each hit on cycle timing, which I think is really important. I know one thing that comes up a lot is we're at a point in a cycle where some people are considering selling to take money out of their investments and potentially exchanging it to something else to protect principal. Who feels the most qualified to talk about opportunity zones? Because I feel like that's an alternative to 1031 exchanges. Rosie, could you take that away for us?
Yeah, but cycle timing first I'd like to talk about. I think somebody said it earlier, I can't remember. They said, my goal was to buy a house every year. Mm-hmm. And that's kind of how our company looks at it. I'm going to build $300 to $400 million of housing every single year, no matter what. And I'm going to build the best $300 to $400 million I can find every year. And as long as I'm doing that, I'm going to hit the highs and I'm going to hit the lows. Mm-hmm. I'm going to be able to capitalize on the highs and react to the lows. And hopefully that's the way that we feel, at least at my company at JPI, we can be the most successful. Opportunity zones is a really interesting thing that I've gotten to dig into in the last few months. Part of the 2017 Tax Cuts and Job Act, the federal government designated various census tracts throughout the United States as opportunity zones, as a way to increase and probably and take some money that is currently sitting on the sidelines and hopefully get them to invest in opportunity zones. It allows you to defer, if you invest in one of these opportunity zones, defer your capital gains and reduce it by up to 15%. If you make an investment in an opportunity zone and you hold that real estate investment for 10 years, you do not have to pay any capital gains tax on your original opportunity zone investment. So it allows you to take capital gains, invest them, reduce that capital gains, and then it allows you to have all of your capital gains forgiven on that initial investment in the opportunity zone. So it's pretty cool and exciting.
There's no requirement to take that new capital gains and put it
No
anywhere else.
requirement. You don't have to 1031 it. Nope, just put it in your pocket. And the hope is that it spurs investment in some of these lower income areas that are in desperate need of it. And certainly, you know, it would kind of get that group mentality. One investment would spur another and another, and that could be a great way for us to add housing in California.
I'll add a little bit to that through the novice eyes, because we're interested in Vista, the building we happen to buy, happen to be in an opportunity zone. It can be selling of Apple or Microsoft stock can be the capital that can come in. So it's basically a vehicle that is a domestic emerging market fund where you can take stock market gains, put it into real estate, and basically benefit from a 1031 vehicle with non-real estate allocated dollars. So the goal of that is, as she so smartly pointed out, was to spur investment. So they're trying to take all that unrealized gain in people's stock portfolios and incentivize them to pull that trigger, take that money without a tax event, and move it over to real estate. So my next question is how much of that do we expect to see, and is that going to help continue to drive demand in price appreciation in markets that have these opportunity zones? That's an open-ended question. I don't know the answer. I would suspect yes, but I don't know. What do you know?
Actually, I was going to ask the experts up there on the panel, does anyone know about California having actually ratified or gone forward accepting those? Because they talked publicly during a press conference, I think it was a few months ago, where California was going to say, yeah, we're going to go along with this federal program, opportunity zones.
No, they have not.
Nothing ever done, the way I understand it, legally to ratify or validate that
get to pay.
happening or coming out the pipe?
You get to pay the California tax now.
You can, sorry?
You get to pay the California tax now. California is not making it easy. Several of us here are involved with apartments. Now, the good news with a crowd this big, we have folks who are in other arenas, but a lot of us do multifamily. And as a certified apartment junkie, I'm particularly interested in this, and candidly, a lot of the transactions are in places like National City, Escondido, City Heights, Spring Valley. They're in cash flow neighborhoods. They're not in neighborhoods with hotels and office buildings. And so it would make some sense, but the reality is that some of the details make it very difficult to do an opportunity zone with apartments, because you've got 30 months after you close. Congratulations, Krystle, you closed yesterday. You've got 30 months to get your money into the new situation. And by the way, the 30-unit building that we just closed for you, the good news, you got a great deal, and you're now zoned to build 20 units. So you can't add more units to it. And if the property that you were buying, you were saying the depreciable value of the assets is $2 million, you have to put $2 million in. And so in apartments, it's almost impossible in San Diego to make that work. There's a few zones and there's apartments there, but most of the apartments in the county have been downzoned. And if you buy it and keep it, doesn't do you any good. You have to add a big chunk of money, and you have to add a big chunk of money soon. So opportunity zones will work in certain situations, but if you're going to do a development deal, you're dependent on the city government to give you the permits. I have a client who has a 4-unit building in Pacific Beach. It's right next to a freeway. It's been next to a freeway for, well, how long has the freeway been there? I guess a long time. 2 years ago, he started to build 4 more units, which he was authorized to do. It was permitted. He's now got $100,000 in fees, and he's thinking within a year, he will probably get permission to build 4 more units where he's legally entitled to build 4 more units. And you know, that would be a challenging situation. If he had started that, he was a Navy contractor, so he knew a little bit about contracting, but it'd be hard to do opportunity zone for apartments in San Diego County. We've downzoned, roughly speaking, we've had 30 plan changes in our county, and 29 of them have reduced the number of units that could be done. It used to be you could tear down grandma's house in North Park and you could build 10 units, and then they changed it and you could tear down grandma's house, you could build 9, and then 8 and 7, and now 5. Well, there's a couple of places in North Park where you can build more, but most of the plan changes that we've had in our county have downzoned. And so the 16 units you're selling, probably they're zoned for less than 16 units now. And the 30 units you could buy, probably they're zoned for less than 30. So our government, in its infinite wisdom, has made it really hard for folks without college degree to get housing here. So opportunity zone is a good place, good thing in many areas. It will be hard for California to fully utilize it for multifamily. It may change, but some of the smartest people I know have looked at it. We can't figure out a way to do it in apartments in California.
So I think that leads us to a good place. I'd like to ask you all one more question and then open it up for questions from the audience. So to take the Aaron Taylor approach, I'm taking you out for coffee. I've taken you out for coffee, and I said, listen, I need one sub-neighborhood in the San Diego area that you recommend for me to take a look at as an investor. What would you tell me?
Good question. I actually really like some of the North County areas. I like Vista, I like Oceanside. Consequently, I'm buying in National City, but I do like some of those more. I like more of the workforce housing. I think that that's a strong sector, and I don't think that it's, I think we're least likely, if you're going luxury, I think there's a lot more risk there than if you're going with workforce housing. So I would say National City, Vista, Oceanside, those are 3 areas that I would recommend.
Terry.
I'm going to follow the lead of one of the wisest women in the audience. And she's in 92113, terrorized her mom. But 92113, 92114, so south of Highway 94, it's one of the few areas that has not been renovated close to downtown. The last 2 transactions we closed here, somebody bought 2 4-unit buildings and they're doing Airbnb and they doubled their income. They doubled their income. Essentially, the folks who live there, they bicycle to grandma's house for Thanksgiving, or they walk to grandma's house for Thanksgiving. And when we come in with college degrees and we pay more, unfortunately, we outbid Cousin Maria. And some of the folks there are not keen that it's regentrifying, but that area, we're getting more and more college-educated folks who are coming in so they can be close to downtown. And 15 years ago, I wasn't smart enough to figure out Golden Hill. I'm so old, we used to call them yuppies. Now we know they're millennials. But 15 years ago, I didn't know whether the homeless were going to prevail or whether yuppies were going to prevail. Well, we now know that the millennials could get the city council and the police on their side, and they pushed the homeless out. Well, 92113, 92114 is changing, and we're getting more education, more income there. And my friend, whose name I won't mention, some of you know her, some of you don't, she renovated all 3 of her units, and she raised her rents more than 25%. She could have gotten more, but each time she had more than 10 acceptable tenants. And she has folks coming in with college degrees, which didn't used to be there, and she's got the pick of the best tenants who are moving into the area.
I would agree with Oceanside and Vista for sure. I live in Oceanside, so I'm pretty familiar with that area. Probably the north of 78, west part of Vista, heading into that Tri-City area is one of the best bets right now. And we've got several of our borrowers that are doing projects up there, so they're constantly looking for stuff. Aside from that North County part, I would say another area is Encanto that hasn't really been targeted too much and still has some really, really good deals out there. And we've got a few of our borrowers that are looking at development projects out there, buying very large lots with an old home on it and take that out and put in a 15-unit apartment building. And the city of San Diego has some great incentives on that if those are going to be low-income housing as well. So I would probably on those 2 spectrums is where I'd recommend people to take a look.
I'm also a fan of workforce housing. I do own in Vista in that opportunity zone that Aaron was referring to, so I like those markets. But I would say invest in what makes sense to you. If it's your local neighborhood, figure out how to invest in your local neighborhood. You need to do what your heart is behind and what really makes sense to you. And then also if you're looking to expand your portfolio into something different, JPI has a common equity program and we're happy to have you invest alongside us also.
I'll obviously echo what Krystle said. If you take the Aaron Taylor approach, you guys want to make $1 million, give me $2 million and go on vacation. I'll take care of you. Vista's the area that I'm in. It's what I know, and I would recommend do something that you're familiar with, and if you're not familiar with it, familiarize yourself with it. I did a deep dive on that entire area. I had the benefit of Dave Plutner of DP Properties, who's a good buddy. I fish with him. Our families know each other, but he's also a successful commercial real estate broker, and I trusted him implicitly. And I think at the end of the day, being a former athlete, the most important part of a good team is trust, because it says the inevitable times of adversity, you can count on me. I will be there. I will do my job. I will find a way no matter what. I'm not smart enough to figure out all this stuff, and nor do I have access to this data, nor the money to be able to pay for it. But I can pick up the phone, I can build relationships, I can learn, I can read a little bit to help me understand what it is I need to know. But surrounding yourself with people that you can trust, that are experienced and are trustworthy is critical. That is the critical piece to the foundation of any success that I've had. And that trust on a team is, whether it's DP Properties and Mind and Krystle and Kenny, it's within my own marriage with my wife, it's in my friendships, it's in everything. That trust has to be there. And I think the reason I'm up here is because I'm a success story, is because I was lucky enough to have good enough instincts to trust and partner with people that I could trust and were trustworthy. So I saw that work 20 years ago when I was blocking, defensive linemen here as a San Diego Charger in Green Bay. And it's still working for me now. Those very same principles are allowing me to change the financial trajectory of our family.
That's awesome. I've heard a few things from you all's talk. Number one is the importance of capital. Take people out for coffee and you can find money under the cup. Number two is the importance of data, just having the information on zoning, on like what's going on in certain lots. Rents to do your pro forma is really important. I think access to knowledge, right? Like understanding the local regulations, understanding opportunity zones and how those work. It's really important. And I think you just hit on it, Aaron, trust, right? Building a team of people you trust, whether it's your capital providers, your brokers, your lenders, your property managers, your construction team, whatever. You need people that you can trust to be able to execute this. So these are all really helpful tips. I'd like to take some questions from the audience if folks have questions. Wendell will come around with the microphone.
Can I shotgun 3 really quick ones?
If they are really quick.
So Krystle, one, what kind of, you mentioned value add. I was just curious what type of 5-year target IRR returns you're looking for.
So basically, we essentially we were investing previously in North Park, so I think our strategy has changed a little bit. So at the time, we were buying value add properties, vacating the building, renovating and fixing it up. If I could get to a 6% return, I was happy, because my bigger thing is building equity, so that way I could go and take that equity to trade it into a larger building. I'm not so much as concerned with cash flow. It's just the property covers it. I get a little bit of cash to put in my pocket, but really it's about that sale so I can trade up into the bigger building, and that's really our goal overall.
Cool. Thank you. And then Rosie, you mentioned opportunity zones, and I was just curious, like, cost per square foot to build, because it seems very attractive to build in the opportunity zone, but then the rents with the high construction costs, how do you make it all make sense?
Yeah, sure.
So where you see, like, what is your build cost per square foot roughly on working man condos?
Yeah, so in my personal stuff that I own, I'm trying to build I'm trying to be all in for one unit at $250,000. And I'm gonna have to really hammer on my general contractor.
Is that land cost too?
Land cost too, yeah, to get down that far.
And then thank you.
And I bought 3 years ago, so
That's
land
amazing.
costs have gone up since then.
And then lastly, I just want to hammer Aaron Taylor there. Like, this guy talks a good game. I just want to say you came down and gave probably the best speech I've ever seen to the Honor Foundation for guys getting ready to get out of the military, expose them to different things. Just want to say thank you publicly. It was an amazing talk. And you talk like you just some guy bumping around, but there's a lot up there, man. Thank you.
I appreciate that.
Hey guys, I guess this is kind of for everybody. I'd love to hear some insight on how you're structuring deals in today's market for apartments in terms of if you're putting financing on the property, what your down payment is, bringing in equity partners, debt partners, kind of all of that.
I can go.
Go for it.
So it is tough, especially in Southern California. I mean, even though we'll go to 75 or 80%, we're really not ever getting there. So it just kind of depends. If you're short on cash and you are buying a deal, especially if there's a value add component to it, I would have a guy like Bruce and get some private money, because he can help you to get, some financing, put his little cash in, so that way you can do what you need to do to get your rents up and maybe refinance out of that into more competitive financing. And then if you do have cash, but you're just trying to retain as much cash as you maximize leverage, we do structure holdbacks or advances in our loans. So let's say that the property, you need $1 million loan, but it's only cash flowing right now to $750,000, but you've got a plan to improve the property and raise rents. We can go ahead and give you that $1 million loan, hold back that $250,000, and then release it to you once you hit those thresholds that support that debt.
I'm seeing more people that are partnering on projects to take stuff down these days, because the market has shifted to the higher end, more expensive stuff, and it does require a lot more capital. So equity partners are very common right now, but networking and developing more private lenders to provide gap funding has made this success for several people that I know. I'm seeing some owner carryback right now as well. There's a couple of projects that we're funding where it's one, for example, up in Vista, just by chance. It was an inherited property, and the heirs are going to carry back the first trust deed on it for the hold period while it's getting renovated. So it might develop into something longer. So I think you got to keep your mind open to lots of different opportunities, have your elevator pitch ready to talk to everybody that you meet about what you do so that you never know what opportunity might come up, just as it did for you with, through your neighbor. And be open to solutions and, that creative, I don't want to call it marketing, but the creative networking and creative deal structure to get things done.
I think we have time for one, maybe two more questions.
How are you handling and managing environmental liabilities?
We start with you, maybe Rosie.
Yeah, the vapor intrusion issues are becoming more and more difficult to deal with, along with other environmental problems. Are you
talking about for construction or lending side or ownership or in what capacity?
Ownership and on construction for redevelopment?
Yeah, on our projects, on our development projects, I'd say 80% of our sites have, because they're all infill, have some kind of environmental problem. So that's a big point of negotiation between us and our lenders on what kind of environmental indemnity we're all providing each other. We generally go more conservative because we're selling to institutions at the end of the day, and we probably put vapor barriers on 50% of our projects. And then we try and really quantify it at the beginning of the day. We'll spend more money on our phase 2s up front, so we can really try and pinpoint what's under the soil instead of finding it out once we're in construction. I've already drawn a construction loan, and I have a whole construction team out there. So we're just trying to be as conservative as we possibly can be.
Last one.
If you have capital right now, is this a good time to invest in more multifamily, or would you hold off for a while if you have a bunch of capital sitting on the sidelines?
Since we've built less than half of what we need in the last generation, I don't think apartments are going to go down. I hope that you and I live through 3 or 4 recessions, maybe 5 or 6. We will have a recession again, but if you've owned your apartment building 3 years or more, you've doubled your capital, and you've probably got the highest rents that you've ever had. And even if your interest rate goes up 1% when you refinance, you're still going to have cash flow. Now, there may be hungry brokers, but there's not desperate landladies who have to sell. So I don't think apartment prices are going to go down. I've been wrong a lot. I can get my wife on speed dial. She can confirm it. But I don't think we're going to see apartment prices go down. House prices have already begun to slip, but not apartments, because we built half of what we need, and half of our people need rental housing.
Awesome. So I'd like to conclude the panel portion of this. At first, I'd like to say thank you all for spending your time and investing your knowledge with us. It's been really helpful. So let's give them a round of applause. You can step down, please.